How does China manage its currency's appreciation? Imagine a country with a currency that's becoming stronger, making its exports more expensive and less competitive abroad. How does China keep its currency from rising too fast? Let's find out. China's currency, the renminbi, is not left entirely to market forces. Instead, the government uses a system called a managed floating exchange rate. This means the renminbi is allowed to move within a certain range, not freely. Every day, the central bank sets a reference rate called the daily fixing. The actual exchange rate can fluctuate around this rate by about 2%. This setup gives some room for the currency to adjust but keeps it under control. When the renminbi starts to appreciate quickly, the central bank steps in directly. It does this by selling renminbi and buying foreign currencies like the US dollar. This increases the supply of renminbi in the market, which helps slow down its rise. These interventions are like a brake, preventing the currency from becoming too strong too fast. China also uses indirect tools. The central bank controls how much offshore renminbi is available outside China. By limiting offshore liquidity, it can reduce speculative buying that pushes the currency higher. The central bank also adjusts a countercyclical factor in the daily fixing. This adjustment helps counteract market forces that might cause rapid appreciation. Another key part of China's strategy is capital controls. These are restrictions on how much money can flow in and out of the country. They make it harder for investors to buy or sell large amounts of renminbi quickly. This limits sudden shifts in the exchange rate and gives the government more control. All these tools work together to help China manage its currency's appreciation. The goal is to support China's export-driven growth, which has been vital for its economy. By preventing sharp increases in the renminbi, China keeps its exports competitive and maintains economic stability. In practice, the central bank keeps a close eye on economic data, trade flows, and global market trends. It decides when to intervene and how much to buy or sell based on these factors. This careful balancing act allows China to gradually let the renminbi appreciate over time without causing sudden shocks to its economy. So, China's approach is a mix of direct market interventions, indirect controls, and strict capital restrictions, all aimed at keeping the renminbi's value in check while supporting long-term growth. This way, China can benefit from a stable currency that helps sustain its economic development.